Welcome to this introductory video on government revenue. We are covering the following topics in this lecture. First, we are going to have a look at federal, state and local revenue over time. Next, we are going to explain some terminology related to taxes that we are going to use in this video as well as in future videos. Next, we are going to talk about tax incidence and then also about tax evaluation criteria. Last, we are going to talk about tax collection steps. Now, let us first start with some observation of government revenue. Note that government revenue, for example by taxes, reallocates scarce resources from the private sector to the public sector. This will affect efficiency and also relative prices in the economy. The consequences are determined based on the method chosen to collect or redistribute those revenue back into the economy. Now note that government revenue is different from taxation, in the sense that government revenue can also occur, for example, if you're purchasing a stamp from the US Postal Service, or if you're paying your annual registration fee, but taxation would be income tax. Of course, taxation is a subset of all government revenues. The most common methods to finance government activity are basically taxation, charges and fee, but note that government revenue can also come from privatization, that is, for example, selling certain items that are in the possession of the government, or also through debt financing. Now, let us have a look first at the evolution over time and how the revenue streams differ based on whether we are considering the federal, the state, or local government. Let us start with the tax revenue distribution at the federal level. So on the horizontal axis, you have the years, and on the vertical axis, you have the percent of GDP, or you have the tax revenue as a percent of GDP. You can see that, for example, Social Security or social insurance, also retirement, has increased considerably over time and has stabilized around in the 1990s, 1980s, 1990s. Okay. You can also see that, for example, the tax on corporations has declined since 1950s until now. The individual income tax has remained relatively stable over time since 1950, around 7.5%. Now at the state level, the situation is slightly different. Here we are looking at the percent of total revenue. And at the state level, you can see that for many states, it is about 30% of the government revenue comes actually from the sales tax. Note that there is no federal sales tax. You also have taxes on individuals as well as corporations. And you can see that also at the state level that the tax on corporate income taxes have declined over time. But note that the majority of revenue from at the state level comes actually from intergovernmental transfers. At the local level, so note this is not the state, but this would be, for example, at the county level, you see that the intergovernmental revenues are again the highest share in terms of revenue, followed by the property taxes. Okay, but then also at the sub-state level, there are also charges and fees that are applied. So tax at the local level is relatively, or say sales tax or individual taxes are relatively minor contributors to the revenue at the local level. Now, before we start talking about taxes, I would like to point your attention to four tax maxims that were postulated by Adam Smith, and they can basically be summarized with equity, certainty, convenience, and economy. And those principles or maxims can be summarized that, for example, equity means that people should pay in proportion of their respective ability towards the financing of the government. Taxes should also be certain and they should not be arbitrary. Convenience refers to the fact that the taxes ought to be levied at the time or in the manner in which it is most likely to be convenient for the contributor to pay it. And then the last, when we are talking about the economy, and we are going to look at this in more detail, is to consider the economic effect of the taxes. As we mentioned before, if you are raising taxes, that changes prices or relative prices in the economy and may actually lead to a reallocation of resources. Now, before we continue, let us start to talk tax terminology. So first, taxes are compulsory payments that are associated with certain activities. Those activities, for example, could be earning income, could be owning property, or purchasing goods. So for example, for earning income, we would be talking about the income tax. Owning property would be the property tax. And then the sales tax would be related to purchasing goods. And again, if you're taxing, then you're reducing an individual's ability to allocate resources. Usually, tax policy seeks to achieve this shift in resources with the least distortion in terms of economic and social harm. Now, there are four terms that we are going to explain in the next slides. This is the tax base, the tax trigger, the tax rate, and as well as the tax incidence. Now, the tax base is the item or the economic activity on which the tax is levied. So, for example, if you're talking about an income tax, then the tax base would be the income that you're earning over 1 year. When you are talking about the sales tax, then the tax is based on consumption. So for example, if you are purchasing a gallon of milk and there's a sales tax, then the tax base would be the purchase of that gallon of milk. Note that there can be general as well as selective taxes. So general taxes would be a tax on the entire tax base and there would be no exclusions or deductions. This is different from a selective tax where only a portion of the base is actually taxed. So for example, you can think about income, then you have tax credits and also deductions, and those would be reducing your taxable income, and hence this would be a selective tax. Now a tax trigger, as opposed to a tax base, is basically the activity triggering the tax liability. So if you are consuming or if you are earning income, then that would be the tax trigger or the taxpayer's action that triggers the tax. It could also be triggered by the determination of the government. For example, if you're earning property, then it is the decision of the government to actually tax that property. Now, the tax rate is the rate at which the tax base is actually taxed. So let us now actually make an example when we are considering income taxes, what the tax base, the tax trigger, and the tax rate would be. So the tax base would be, of course, the income adjusted for exclusions, deductions, exemptions, and credits. And note that we are going to talk about this in much more detail in the section on income taxes. Then there's the tax trigger, which is basically engaging in an activity that generates income. And then the tax rate would be a graduated schedule. What the graduated schedule means is that there are actually what are called marginal tax rates associated with the various incomes. And here it is important to make the distinction between marginal tax rates and effective tax rates. So the average tax rate is basically the tax rate collected by the tax collected divided by the dollar value of the tax base. The marginal tax rate is the change in tax collected divided by the change in the value of the tax base. And then here I also have the decision of the effective tax rate. Now note that the effective tax rate seems to be similar to the average tax rate, but here whereas the average tax rate is related to the tax base, the effective tax rate cannot necessarily be related to the tax base, but for example could be the ability to pay for the tax. For example, it could be income or wealth. The effective tax rate is actually used as an indicator to see of whether a tax is progressive, proportional, or regressive. Now let us make a numerical example to differentiate between a proportional, a progressive, and a regressive tax. So suppose that you have three individuals, A, B, and C, and that they have an income of $10,000, $40,000, and $100,000. Now, a proportional tax would simply be that the person A, B, and C, that they pay, for example, 10% on their income. So that would be $1,000, $4,000, and $10,000 for taxpayer A, B, and C respectively. Now, a progressive tax is if the average tax or the effective tax, so here they are identical, or I assume them to be identical, if the effective tax is actually increasing with the income. So here, for example, if person A pays $1,000, person B pays $5,000, and person C pays $20,000, then the effective or average tax rate would be the 1,000 divided by 10,000 would be 10%, and you see that this is increasing with income. The opposite occurs with a regressive tax. Note here that although the tax amount increases with income, but it does so at a regressive rate, in the sense that the average tax decreases from 10% to 6%. Now, let us have a more applied look of how the tax rate for income is actually determined at the federal level. So usually you have the two schedules, one for a single household and one for a married household. Now you have tax brackets. So for example, take a married household and their tax schedule. So here, on income between $0 and $19,050, they are paying 10%. On income between $19,000 and $77,400, they are paying 12%. On income between $77,401 and $165,000, they're paying 22%. Note that everybody pays 10% for the first $19,050. So what do I mean by this? Consider the following example. So here you have a married couple with a household income of $137,000. So note that here the $137,000, they fall in between those two values. So they're paying 10%. They're paying 10% in the first bracket, the $19,050. Then they're paying 12% in the second bracket. So here they're paying the difference between $77,400 and $19,050. And then they're paying 22% on the difference between $137,000 and $77,400. So their tax liability is $22,019. Now note that this gives a marginal tax rate of 22%, because here they are since they are in this tax bracket, the marginal tax rate is 22%. However, their average tax rate, the $22,019 divided by their income, is actually only 16%. So when you are plotting this over time, then we have the average tax rate here on the vertical axis and the income on the horizontal axis. And so here I have income from $0 to $1 million. And you see of how the average tax rate evolves over time. So sometimes you hear that people not understanding the concept of marginal and average tax rate think that if you are, say, paying $165,000, that your average tax rate is 22%, and that if you are earning $1 more, that you now have to pay 24% as the average tax rate. Now, this is not true, since everybody pays the same same for the first $90,050 and so on. So this is something to keep in mind. Now next, let us have a look at the so-called tax incidence. Now, the tax incidence is defined by the person paying the tax. But this is not always clear. So for example, if you are having a property tax on rental income, then the person paying required to pay the property tax is the landlord or the person owning the building. But that person will certainly recover some of the property tax from the renters. Okay, so here in this case, the legal incidence of the tax or the party responsible for remitting the tax would be the property owner. But there's then we also have to differentiate to the legal incidence from the economic incidence, and that would be the party bearing the economic burden of the tax. Okay, and note that those determinants for the economic incidence also depend on the elasticities of supply and demand. And here we are going to watch a video. Let us have a look at economic efficiency. Consider this case where we have the demand function and we also have the supply function of a particular market. And initially we have an equilibrium where the supply function intersects the demand function, and we have an equilibrium quantity and an equilibrium price. Now in this case, assume that this is a perfectly competitive market and that the social welfare is maximized. That means we have the consumer surplus, which is represented by this upper triangle, and we have the producer surplus, which is represented by this lower triangle. And in sum, they represent the social welfare or so-called social welfare. And since this is a perfectly competitive market, we have the maximum welfare. Now let us consider the case where we are imposing a consumer tax on producer. Now if we are having a producer tax that increases or that shifts the supply function to the left, by the amount of the tax. Okay, and so here note that we are talking about a per unit producer tax. So per unit of output, the producer has to pay a tax. So now we have this new equilibrium here, where we have a lower quantity. Let's call this QT. And we have a higher price. Let's call this PT. And also note that there is now a difference between the price paid by the consumer and the price paid by the producer. In the sense that we have the price paid by the consumer. Let's abbreviate this with PC. And here we have the price with the tax that is received by the firm. Okay, let's, instead of calling it producer, let's just call it a firm. Okay, and so the difference between the price of the consumer and the price of the firm is the amount of the tax. Okay? So you have, since this is the quantity exchanged in a market, the tax revenue is represented by this area here. Okay, so this is the amount that goes to the government. But note now that we also have a reduced producer surplus and we have a reduced consumer surplus. Okay, and note, and this is the important aspect here, is that we also have an efficiency loss, since this triangle here is not allocated to either the government or the producer or the consumer. So this would be the deadweight loss. And note, if you remember from the video about the role of government in the economy, we noticed that, for example, if we have a situation where the market produces an externality, that such a tax can actually restore efficiency. Now here in this case, we have a deadweight loss, though a loss in efficiency associated with the tax. Now note, when we are talking about tax incidence, okay, then you see that we also have here a wedge between the what the producer pays and what the consumer pays, in the sense that you often hear people say that, well, if we are taxing producers, then they are only simply going to transfer that tax to the consumer. And here we can see that this is actually not true. Since we have a downward sloping demand function, the producer cannot simply increase the price by the amount of the per unit tax and sell the same number of goods. So here we are actually having some of the tax burden is on the consumer, okay, which would basically be represented by this distance here, and some of the tax burden is on the producer, which is represented by this burden here. Okay, so here this is a first graph about the economic efficiency. Next, let us assess of how a producer tax is different when it is imposed in a market with an inelastic demand as opposed to a market with an elastic demand. Okay, so let us have a look at the inelastic demand first. So like before, we have supply and we have demand. And this is an inelastic demand in the sense that even if the price changes by a lot, the quantity demanded is not going to change by much. So here we are initially in an equilibrium where we have the equilibrium quantity and the equilibrium price. Now assume that we are, like before, we are imposing a per unit tax on the producer. So here this is the supply with tax. Then you can see as before that we have a new quantity, a new equilibrium quantity with a higher price for the consumer. So let's call this price with tax for the consumer. And we also have now a price received by the firm, and the difference between the two lines is what is the amount of the tax. Now here there are a few things. Note that the steeper this curve gets, or the more inelastic demand is, we would see a smaller deadweight loss as opposed to the previous example that we have seen. Now also note that here the tax incidence, since we have an inelastic demand, is actually mostly on the consumer. Okay, So here, think about an inelastic demand, which is caused by the fact that, for example, this product is something that is necessary or that is important for the consumer. And hence, since the consumer needs it, that this is the reason why the demand function is inelastic. Now, in this case, the producer has a much better ability to transfer the tax incidence or the tax burden onto the consumer. Okay, so here the majority of the tax is actually paid by the consumer and a smaller part is paid by the producer. Now, if you consider this in a case where the demand is actually elastic, in the sense that if you change the price by a little bit, that this results in large changes in the demand function or in the quantity demanded. So let us again impose this per unit tax. So here we have the supply, the original supply, and here we have the supply with tax. And then of course we have the demand here. Then now you can see that we have a reduction in the quantity demanded, okay? And that we now have, again, this price wedge between this price differential in the amount of the tax between what the producer receives and what the consumer pays. Okay, and here again is the amount of the tax. So this example illustrates that depending on how those curves are, the slope of those curves, that you can have different incidences on the tax. Okay, so this is what is meant by tax incidence, in the sense that here we do have indeed the producer that is responsible for paying the tax, since it is a producer tax, but that it is actually shared between the producer and the consumer. The next topic are criteria to evaluate taxes. There are 5 tax evaluation criteria. There is economic efficiency, equity, adequacy, feasibility, and also transparency. Now, let us first look at economic efficiency. As we have mentioned before, that in the case of a perfectly competitive market, we have a market equilibrium that is an efficient point maximizing consumer and producer surplus. That is social welfare. Social welfare, remember, is the sum of consumer and producer surplus. Basically, this is a situation where the production of goods that are most desired by consumers occurs, and the production of those goods also happens at the least cost possible. And then those goods are distributed to consumers based on their willingness to pay. If we are imposing taxes in this market, then this may lead to a lower efficiency than pre-taxes, because it changes the relative prices associated with the goods. Note that the exception here are instances of market failure. So for example, if you are producing, or if you're having a market that is producing a good that is imposing a negative externality, then a tax can actually restore efficiency. We have seen this in the video on the role of government in the economy. Next, we are going to look at equity. Here, equity refers to assessing the tax fairness based on equity standards. Usually, governments have multiple goals and objectives when taxing, and equity objectives may or may not be explicitly considered in setting a tax rate structure. So here, there are 2 equity standards that we are going to look at: ability to pay and also the benefits principle. Note that within the ability to pay principle, we also differentiate between horizontal equity and vertical equity. So let us have a look first at the ability to pay principle. Under the ability to pay principle, tax payments are based on the taxpayer's ability to pay, potentially measured in terms of income or wealth. We have talked about this before when we looked at the example of progressive versus regressive tax rates. So there are two notions with regard to ability to pay, and that is horizontal equity, in the sense that people with the same ability to pay the same effective tax rate. For example, if you have two people that are earning the same income, then horizontal equity should make them both pay the same taxes. You also have vertical equity in the sense that people with different abilities to pay should pay different effective tax rates. Now, when we are looking at the vertical equity, that again, we can look at progressive, regressive, or proportional tax rates. And we have seen this in the past. And remember the numerical example where we had those three taxpayers earning $10,000, $40,000, and $100,000, that we now have here, this example that looks at the vertical equity, in the sense that they are paying according to their ability to pay. So even in the case where you have the person paying paying $1,000 in taxes when earning $10,000 and $6,000 in taxes when they earn $100,000, then you could argue that yes, here you still have the case of vertical equity, because here you have a different ability to pay and they are also taxed at different amounts, but yet you have to differentiate, but that in this case, they are actually in a regressive tax system. So there are not straightforward measures to actually evaluate vertical equity, in the sense that you could have vertical equity but a regressive tax system. Now, the benefits principle is slightly different. Here, the concept is that people who are benefiting from a particular service provided or good provided by the government, that those people should actually be paying for that good or service. So you can think, for example, about the motor fuel taxes at the federal level and also at the state level, where the revenue from a motor fuel tax actually goes to road construction and road maintenance. Here, people that are using the road, drivers, are getting gasoline and diesel at the pump, and they're paying a tax for that. And hence that tax goes directly into the road construction and road maintenance, and hence benefits those that are using the road, that is drivers. Now, there are some arguments in favor of using the benefits principle, in the sense that there is an intuitive notion of fairness, in the sense that people who are using a service should be paying for it. And it also has the advantage that it may encourage people to actually conserve public services by consuming less of it. Now, there are also arguments against the benefits principle. And the two main ones is that it is sometimes very difficult to actually really delineate of who is benefiting and who is paying from it. And that it also, the second one, relates to the vertical equity, in the sense that you may have people that are requiring to use a particular service, but they have a lower ability to actually pay for it. Now, the topic or the other tax evaluation criteria is adequacy, in the sense that you're thinking about how much revenue can actually be generated at a reasonable tax rate. So usually broad tax bases such as income or sale are preferred, because you can have a significant revenue from a relatively low tax rate. But with regard to adequacy, there are also cyclical considerations of tax revenue. So consider the case again of a tax on gasoline. Right now, in most states, the tax, and also at the federal level, the tax on gasoline is on a per unit basis. That is, you're paying, for example, 25 cents per gallon of gasoline that you're purchasing. So that per unit tax is independent of how much the gasoline actually costs, in the sense that whether gasoline is at $2 or whether gasoline is at $5, the government still collects revenue of 25 cents per gallon purchased. Now, if, for example, the gasoline tax was actually levied as a percentage of gasoline price, Suppose it would be like a sales tax of say 5%, then 5% on something that costs $2 is different than 5% of something that costs $6. And hence the per unit tax was probably chosen because it stabilizes the tax revenue over time. And then there is also the concept or the evaluation criteria of administrative feasibility, in the sense that what is the administrative cost to actually collect the tax revenue, and also what is the compliance cost for the taxpayer. Some taxes may be more complicated to collect, both for the government or even to comply for with the taxpayer. And hence you should have a preference for tax that is easy to administer. Last but not least, there is also the political feasibility of a tax, in the sense that citizens are usually, in many cases, are opposed to new taxes, and taxes are usually a very controversial issue. So you have some people that are completely tax intolerant, in the sense that they reject any further levels of taxation. Sometimes a new tax may suffer from a sticker price shock, in the sense that you have low support because of the initial tax increase. And then you could also have the case where citizens apply a reasonable standard of weighing the benefits of the tax, for example, better roads, and as opposed to or comparing it to the cost of, say, for example, a higher motor fuel tax. Usually a tax decreases, the tax popularity decreases with tax visibility, in the sense of how easy it is to actually spot the tax. Now, the last topic that we are going to cover here are tax collection steps. And those steps are relatively straightforward. So first, if you want to tax, you have to rely on actually taxpayer registration and also the measurement of the taxable activity. So for the taxpayer registration, you would have to, for example, compile and maintain taxpayer information such as social security numbers, taxpayer identification numbers, or even parcel numbers that are usually associated with property taxes for homes. Then you also have to assess or declare or tabulate the taxable activity. So you have to measure the personal income tax, you have to measure miscellaneous income, interest income, etc. So for example, for the personal income tax, here this requires companies to actually withhold some of the income that are paid to you in as a tax and submit that to the government. There is, of course, also an entire system behind the revenue and taxpayer accounting, in the sense that tax payments have to be deposited, they have to be recorded, and they also may have to be redistributed in terms of a taxpayer refund. Of course, there also needs to be mechanisms for delinquency control, compliance, and collections. And usually that is also achieved with audits that are actually ensure compliance with the tax law.